Well, President Trump blasting Fed's Chairman Powell, following the decision to leave those rates unchanged yesterday. So in a post on Truth Social, Trump says Powell is costing our country hundreds of billions of dollars and that we should be 2.5 points lower. Let's bring in Roth Capital Partners chief economist and market strategist Michael Darda. Michael, thank you so much for being here. I want to get first your reaction to what we saw yesterday, that rates didn't go anywhere. And then also, the Wall Street Journal editorial board talks about this tariff jolt that Powell is facing. And at the end of it, they say, President Trump criticized Powell again on Wednesday for not cutting rates. Lifting the tariff wet blanket would do far more for growth than a quarter-point cut.
Right. Well, fair point there. Look, if we look at the Fed's forecast and the way that it changed with the survey of economic projections, they raised their expectation for inflation, cut their expectation for real growth. And so it's really ambiguous from a dual mandate perspective in terms of what you would do with rates. Probably you just sit there and watch the data, and that's essentially what Powell said that the Fed was going to do. So this really wasn't outside of where expectations were, although certainly the White House is not happy with it.
But they upped their inflation projections, and then they also talk about slower growth.
Right.
So that tells me that the case is being made in their minds for a cut.
Yeah, I do think that they're probably going to start to move rates lower in the fall, but they just want to be more confident that you're actually getting a weakening in the economy. What they don't want is the tariffs to start bringing higher inflation. And then if the labor market is still really, really tight, then that inflation starting to get into expectations of higher inflation and a bit of a spiral occurring. So there's a bit of, once bitten, twice shy here going on with the 2-year inflation overshoot that the Fed presided over. And so they're just nervous and they're going to be cautious in terms of continuing to lower policy rates. They really want to see evidence that growth is slowing, not just in the forecast. So they're going to be reactive instead of proactive.
Yeah, well, and also, too, you say the current fear is that the lagging effects of tariffs and a potential hot war in the Middle East, that is the kind of the inflation story, but we don't know for sure yet. We're kind of in a wait-and-see pattern on that. The other issue is the federal debt. And I wanted to get your reaction to this because, the Treasury Department gave our colleague Edward Lawrence this last night. 31.4% of the $36 trillion, $11 trillion, doing the math, of U.S. debt has to be refinanced within the next year. So we've got to refinance that debt in the next year. And if rates aren't lower, which is obviously what Trump wants,
right,
that's the end game to me. How do you think Powell reacts to that?
Well, I think, the way Powell is reacting is saying the best thing that we can do for long-term interest rates, which will matter the most in terms of debt financing costs, is to keep inflation low and stable and presumably at target. And so that's really the most important thing that Powell can do. I think that the criticisms of Powell would probably be more relevant if inflation expectations were too low. If you look at where bond market inflation expectations are, right now, they're perfectly anchored at levels that would be consistent with 2% inflation. So the Fed's doing quite a good job here. When they started cutting rates last fall, those expectations were tanking and labor market data was weakening. And so that really did justify the Fed moving. And the pause came about as, the data surprised to the upside and those expectations recovered. So, I think that the Fed's really doing a pretty good job here.
Okay.
And that's really the mission. Keep those expectations low and steady. In addition to that, how about not running 7% of GDP fiscal deficits at full employment? If we're worried about the debt and the deficit and refinancing costs. So, back to the basics on some of this stuff. Well, and that really is not something that the Fed, has any sway over. It's Congress.
I was going to say, talk to the politicians on that one. Yeah. Real quick, just switching gears with you. You recently changed your view. You were an AI skeptic.
Yeah.
You were bearish on tech. Now you're optimistic. You're bullish. What changed?
Well, a couple things changed. One is that just my own interaction with these AI interfaces has improved dramatically from where it was a year ago. I mean, a year ago, it took me more time to correct the mistakes trying to use AI than it did, than it saved me in terms of efficiency. Now it's, totally different. I mean, really, really incredibly helpful. And so, usually markets are onto something when they're moving the way that they have, with the tech leadership that we saw over the last 2 years. The correction that we saw, most of which came in February into early April, was an occasion to change the view. You don't want to change the view at the top of the market and then, right, you're wrong twice.
And you did change your view.
I did.
Yeah, you did. All right. Well, thank you so much for the commentary, certainly. There's, again, a lot happening today. We appreciate you coming in with the markets closed.
My pleasure.
All right, Michael, thank you.